Hello and welcome to Quilter Cheviot Markets Uncut or Cut, your weekly insight into topics and trends facing the markets. My name is Charles Mesquita, Charities Director at Quilter Cheviot Investment Management. I'm delighted to be joined by Richard Carter, Head of Fixed Interest Research, and Alan Mcintosh, Chief Investment Officer, Europe. Please don't forget to like and subscribe. And if you haven't done so already, you can catch us on Spotify, Apple Podcasts, YouTube, and on our website. We would love to have feedback, so please send us comments and questions. So, being the start of the year, I think it's a good time for reflection, particularly as we've had our first dusting of snow. Some people have more than others. So perhaps we should start with a review of 2025 and what surprised you. Alan, perhaps I'll start with you first.
It certainly was a year of surprises because, going back to January, we had already, seen quite a move in AI-related tech stocks in the previous couple of years. And then news came out that China had developed an open source, cheaper version, if you like, of large language model learning capability. And that really hit a lot of the big tech stocks like NVIDIA. Amazingly, that was fairly short-lived, and the AI capex boom continued to roll out through the remainder of the year, and obviously this is a big topic for 2026, which I guess we can get on to. The next major event was early April, when Donald Trump announced his Liberation Day. Interesting euphemism, by slapping tariffs on virtually every country in the world. And again, that caused quite a ruction in markets. I think at one point, the US stock market was virtually in bear market territory from its earlier peaks. Again, a lot of these were reversed fairly swiftly. A new acronym was coined, TACO. Trump always chickens out. And he did seem to back down on a lot of the more punitive tariffs, particularly when he went toe-to-toe with China. And China really was, tit for tat, kind of pushing up their tariffs on goods coming in from the US. So again, as those threats seemed to recede, stock markets kind of took heart from that. And so I suppose the biggest surprise is that from that period, it was quite hard to imagine that stock markets would have another cracking year. And they did. And I think it's the third year in a row we've had double-digit returns in global stock markets. The other feature, of course, which was a byproduct, I guess, of the tariffs and just general unpredictability of US policy, was the dollar weakened by around 10% in the first 6 months of the year. Very, very steep decline in a short period of time, not actually seen for some decades. And so there was worry about effectively the US weaponizing the dollar. And so you saw quite a move from countries diversifying away from the dollar, and that put further downward pressure. Last 6 months, though, the dollar seems to have stabilized. So again, we come into 2026 where there's still a lot of uncertainty, but markets do seem to be very good at shrugging this off. Obviously, a lot of moves in monetary policy, interest rates, etc. But I'll let Richard cover that off.
Yeah, Richard.
Yeah, I'd echo what Alan said. I mean, for me, the thing that is most surprising and just confounds me sometimes is how resilient markets are in the face of all this news. And I think if you just sort of read the back, front pages of the newspaper every day, you'd think, crikey, the world's in a write-off state. And then the FTSE was, Alan, up, made 25% returns last year or something.
Pretty much,
like
certainly
that.
Over 20. Yeah,
it's incredible, really. And I think also you could say that in bond markets. People say, well, Rachel Reeves and the budget and the fiscal side's a disaster, and look at what's going on in France and all the rest of it. Well, UK corporate bonds made about 7% returns last year, and gilts made 5%. I don't think most people would be too unhappy with that. I mean, some things were, I guess, a bit less surprising. Central banks cut interest rates, but it was a fairly gradual process. That was kind of what we thought it might be. Inflation seemed to be coming down a little bit and a bit more under control. Again, that was to be hoped for. So I suppose those were a bit more predictable. But I just think the resilience and the demand for assets, and whether that's on the equity side or the fixed income side, the search for yield and all the rest of it is pretty remarkable. So hopefully we'll see something like that again this year, because let's be honest, we already had this kind of Venezuela raid. The geopolitical side of things is highly unpredictable and fraught with danger. Obviously got the ongoing conflict in Ukraine, which threatens to get not be resolved or even get potentially worse this year.
Yeah, it does appear, doesn't it, that where we thought we might have a quiet Christmas, it certainly wasn't a quiet Christmas, or perhaps we were hoping for that, and it was a very noisy year, particularly out of the US. So the year has started with a bit of a sort of from a geopolitical point of view, a fairly noisy basis. Do you think the markets are going to continue to shrug this off? I mean, what are your expectations for 2026? What are the things do you think are going to worry you most in 2026?
Should I come in on that first?
Yeah, you come first.
Yeah, I still think the geopolitical side is the most worrisome. I'm not, I do think inflation will continue to come down. I think growth will be kind of certainly in this country, sort of going sideways and not doing much else. US, with Trump's policies, maybe there's a bit more upside potentially there. But I think the sort of macro backdrop is not too bad, and tariffs aside, relatively, I hate to use the word, but relatively stable. Actually, I think inflation's a bit more under control. Growth's kind of okay, but nothing spectacular. What worries me is Trump's ability just to do remarkable things, and the whole sort of success really of what happened in Venezuela potentially. In the short term anyway, might embolden him to do other things. I still worry a lot about Russia and Ukraine, obviously the US-China relationship. So I think the sort of geopolitical side is what concerns me more than anything else. The one other thing worth mentioning is just, and again it's US and it's Trump, unfortunately, gradual erosion of maybe sort of democratic norms and potentially Fed independence. The US have got to appoint, Trump's got to appoint a new Fed chair at some point, probably this month, taking over in May. There's a real worry in markets about the Fed's independence and control of monetary policy and sort of being free of influence from the politicians. If that gets further eroded, that could cause problems for bond markets particularly. So that would be up there for me. I mean, the UK, I know there's a lot of chatter about Starmer and Reeves and all the rest of it. I mean, if local elections are coming up in May, it's a long time until we get actual general election. So I think the concern would be if Starmer was replaced with a let's say a more left-wing prime minister, sort of Angela Rayner, that sort of thing. That could be a worry for gilt investors. But I think the more political worries are in the States for me.
What about you, Alan?
Yeah, I mean, I agree with what Richard was saying. The geopolitical situation is forever moving and usually not in a good way. The question, I guess, a lot of people are asking, are markets in a bubble? Is the whole AI thing redolent of previous, whether it was the dot-com boom, subsequent bust? People are even making comparisons with, the railroad investments in the middle 19th century, which again was a massive capex boom, but actually a lot of the investors in the early stages certainly lost a ton of money. So, you can actually have fantastic improvements in technology, but they don't necessarily deliver good returns to early investors. So that's the conundrum that I guess people are facing in terms of AI. I mean, the thing in markets generally, just to kind of echo what Richard said, the macro environment is quite benign. There's a reasonable chance we could get more interest rate cuts in the US, possibly the UK, maybe less so Europe. Japan's going the other direction by raising rates, but there's plenty of liquidity around, and liquidity is supportive of markets. And if you ask what could go wrong, what would end this, kind of charge forward, particularly in the big tech stocks, historically it's been a change in monetary conditions, monetary tightening, interest rates going up. So, in 2000, the internet bubble burst because interest rates were going up. So cost of borrowing, lots of heavily indebted companies suddenly found their interest costs on their debt going up quite savagely. And there is it may just be a marginal concern, but Richard was mentioning that you could get unease in bond markets because of things happening, such as challenges around Fed independence and the ballooning fiscal debt in the US and most other developed economies. And there doesn't seem to be any appetite to rein in that debt. So that's got to be financed. So, it wouldn't necessarily even have to be an increase in interest rates. You could just see a tightening in monetary conditions through higher bond yields that might just, cause markets to retrace some of the gains that they've seen. I would say these are outlier events, but we have to be looking at all possibilities. We can't just say it's all green light everywhere, charge on. Our job is to make a balanced judgment and look at different scenarios and kind of try and assess the likelihood of good outcomes as well as bad outcomes. So I don't see the same returns in equity markets in 2026 that we saw in 2025. But at the moment, it's hard to see why you wouldn't see markets continue to make progress from here. And, again, I'm absolutely no expert in the whole AI thing, but, at the moment, the big, what they call the hyperscalers are making a ton of profit in their other businesses. And, that is supportive of a lot of the spending that's going on. The slightly worrying thing is you're now seeing some heavily debt-funded financing going on. And again, if we saw a change in monetary conditions, a tightening of monetary conditions, then some of these companies that are borrowing a lot of money to fund this capex could get into a little bit of trouble, and that would, cascade through the rest of the market. But again, there's no sign of that stress at the moment.
And what about regulation and stuff like that? Because you do sort of slightly get a feeling that, particularly around tech, social media, and everything else, it's still a bit Wild West, which has suited the states and been very good for them. But at some point that it's probably going to be the only way it's going to get reined in. And do you think that Europe will have the gumption to actually to start that ball rolling? I don't know which one.
Let me just start off. Actually, I don't think so. Yeah. Certainly in the US, which obviously is dominant in the tech sector. I think there's a recognition that these are national champions, and there have been attempts to try and kind of carve up the monopolistic behaviors of some of these tech companies, but that's not been punitive, shall we say. It's not disrupted these businesses substantially. But I think there's a recognition that the US wants to be the leader, the global leader in this space, and higher regulation would just be an obstacle. And elsewhere in the banking sector, you're seeing deregulation in the US and actually in Europe as well. So again, that's supportive of more lending, more liquidity, and again, consequentially, supportive of markets. So I'm not really getting a sense that we're in an environment where regulation is going to get tighter. I think if anything, it's perhaps going to be too lax. And lax regulation, particularly in financial services, has caused problems in the past, as we know well. So, no, I don't actually see that as a headwind.
Yeah. What about you, Richard?
Yeah, I agree. I think the trend seems to be, if anything, towards deregulation. Isn't the phrase normally the US innovates and Europe regulates? Is that right? I
Yeah,
think
absolutely.
that probably won't change. But Europe, this whole Europe US relationship is fascinating. Not just over sort of tariffs and trade. You've got this sort of the whole NATO thing and Greenland now into the mix, and I think Europe won't want to upset the Americans too much over the whole tech sector and tax on that. So that's going to be one to watch as well.
Yeah, I just wonder how far they're going to be pushed, and it does seem at the moment they're absorbing it. Where at some point they're going to have to turn around and say enough is enough.
Well, they are. I completely agree. And Starmer's, obviously trying to play this whole game of not criticising Americans, but trying to sort of appease backbenchers and all the rest of it. It would be a huge worry if we saw a break in the relationship between Europe and the US, not least with the whole sort of Russian threat on the eastern border. So you would hope that. Europe and the US can sort of keep relationships on even footing.
Yeah. So from an investment perspective, it's really just sort of more of the same. Are there anything that you think that investors should be thinking about? It's time in the market rather than out. It's we're not anticipating any great shocks or reasons to be moving too defensive.
Yeah, I mean, the truth is it's always the unexpected that creeps up on you and hits you in the back of the head when you're not looking in that direction. And that's always these kind of so-called exogenous shocks like COVID or whatever, very, very difficult to predict. So as you say, stay invested. As I think the outlook for equity markets, they're not cheap. The US is certainly not cheap, but there are other areas of the world that still look quite attractive. UK, Europe, emerging markets in particular. The valuation gap has narrowed a little bit with the US, but it's still 20-30% cheaper, and arguably the outlook for those regions is a lot better. Europe, slow growth, but actually the fillip that will come in Germany in particular through infrastructure spending and higher defense spending will trickle down to the rest of Europe. Emerging markets have benefited from the weaker dollar, US interest rates coming down, and they're delivering good economic growth rates and good corporate profit growth rates. So I think a lot of it hinges around the outlook for corporate profits, which still is pretty healthy globally. So I think, countries will probably want to continue to diversify away from dependence on the dollar. The US has been running huge trade deficits, and obviously that means other countries are holding lots of dollar reserves. But what you're seeing is more trading, intra-regional trading, particularly in Asia. So China has reduced its surplus with the US, but it's actually trading with other parts of Asia. So that's in a sense what's fascinating about how flexible the global economy is. The response to, for example, lockdowns, countries being shuttered during COVID, innovation, just smarter ways of doing business. And that's what always keeps me optimistic about markets. They're not static. Companies are not static. They adapt, they evolve to changing conditions. So as long as that kind of animal spirit, entrepreneurialism continues, then you have to stay positive. Diversification, absolutely. I think our classic kind of multi-asset approach is correct, and within equities, diversify by region, and I think that's the right way. And fixed income, you are getting positive yields. You went through a period where we had zero interest rates and returns were very low, but we're actually seeing interest rates stabilize around inflation levels, maybe a little bit above in some countries. So that's good. So it means that virtually every asset class is investable.
And what about bond markets, Richard?
Yeah, just on the sort of equity side, there's bound to be a shock at some point, but recent history or for a while has been just not worried too much about it, and as you say, stay invested. And I think when you look at bond markets, if you put some gilts in there, some invest high quality corporate bonds, you're getting a starting yield around 5%. So that's pretty good. It's better than what you can get on cash comfortably. It's now comfortably above the rate of inflation as well. So if there is a bit of a shock in the equity market, I think bonds are well positioned to do pretty well. And then if we just have a sort of sideways year in fixed income, that's also not a bad return. 5% for a sort of fairly low risk asset class, or most of it's low risk anyway, we would think. So I'm pretty positive about that. One area would concern me a little bit, corporate bonds spreads, so the excess yield you get over government bonds is very tight. That just reflects the resilience of the global economy and the strength of corporate balance sheets, as well as worries about government fiscal deficits. But so if there is a bit of a shock in equities, then potentially spreads could widen. But as I say, overall, with a 5% starting yield, on the broad market in the UK, I think that looks pretty attractive.
And just on inflation and interest rates, expectation for interest rates in the UK,
they might come down a little bit more. There's clearly a very real sort of split on the MPC about direction. There's a lot of focus on wage growth and all the rest of it. They might come down, maybe about 50 basis points or so. That's the sort of broad expectation, assuming there are no sort of major shocks. Similar in the US, but then you've got to throw into the mix the whole sort of Trump thing around lack of Fed independence. ECB wouldn't surprise me if they don't make any rate changes all year, to be honest. And inflation gradually normalising. I think there's more to go in the UK. Recent news has been quite good on that. US potentially a bit more sticky with the impacts of the tariffs.
I think the sort of conclusion from the conversation really is that the crystal ball is quite murky. There's an awful lot of things you can worry about, but at the end of the day, actually markets have been extraordinarily resilient as of businesses going forward. And it's more about being in the market rather than out of the market.
Yeah, the old saying, markets climb a wall of worry, is absolutely true. We probably overthink some of the time, or most of the time. So I think it's a fairly benign environment, barring some extraneous events that we'll never predict.
Well, my wife tried to make me, as a New Year's resolution, is not to carry on watching the news coming out of the US. I'm not sure I'm going to succeed in doing that. Thank you, Richard. Thank you, Alan. As always, to say we live in interesting time would once again be an understatement. Thank you for listening. We would love to hear from you. If you have any questions or want us to cover any particular topics, do please get in touch and do share this with friends and family.
This podcast is marketing material, not investment advice or research material. Investments can go up as well as down, and past performance isn't a guide to the future.